Oil watchers continue to monitor tensions in the Middle East. The U.S. and U.K. launched more airstrikes in Yemen overnight, the latest move in their effort to stop attacks by the Iran-backed Houthis in the Red Sea. This fresh round marking an 8th allied attack on the Houthis since January 12th, and they were supported by a broader group of countries, those allies, that is, including Canada. Our next guest says the energy market may still be mispricing the risk of a major oil supply disruption caused by conflict in the Middle East. Let's bring in Clay Seigle for more. He's Global Oil Service Director at Rapidan Energy Group, and he joins us from Houston. Great to have you with us. First off, maybe you can put into context what is happening in these latest airstrikes and what the U.S. and U.K. are seeking to achieve here.
Well, good morning, and thanks for having me. I think that you have it exactly right in that the market is mispricing the risk of oil supply and gas supply disruptions emanating from the growing conflict in the Middle East. And it is continuing to spread, these attacks on shipping, despite the fact that the United States and UK armed forces have undertaken a campaign to degrade these Houthi capabilities to attack shipping and also try to deter their decision makers from undertaking additional attacks. But those attacks have continued, as you said, over the past week or two. There's no sign that the campaign to halt these attacks on shipping is likely to succeed soon. So what that means is that oil supplies and gas supplies are liable to continue being redirected. Instead of being able to use the shortcut, that is the Red Sea, connecting Eastern and Western Hemisphere energy markets, they're probably more and more ever going to have to take the long way around the southern tip of Africa. It doesn't exactly remove oil from the global market, but it increased costs because tanker capacity is limited. So these longer routes are going to increase the costs of freight for oil and gas shipping. And for those guys that are still continuing to use the Red Sea shortcut, they're going to pay higher insurance costs because of the war premium risk in that region.
So is it your view that the airstrikes that we have seen in Yemen will not ultimately serve as the deterrent needed to end the Red Sea activity, the Red Sea attacks?
Well, that's the key question. This is designed to change the intentions of the opposing force, which is their desire to attack shipping. Now, from the Houthis' own spokespeople, they've said that as long as the Israeli military campaign in the Gaza Strip continues, their attacks on shipping related to Israel are going to continue. And of course, we've seen attacks on shipping that seem to have no clear link to what's going on in Israel. But I just want to emphasize that the main risk for oil markets in this whole Mideast conflict is the potential for Iran, the sponsor of the Houthis, and Hamas, and Hezbollah in Lebanon, to become directly involved in the fighting, either against Israel and or against the United States. That's only a 30% probability, but it would be like a $40 spike in the price of crude oil in our estimate. So a 30% risk rating on a $40 event should be about $12 of geopolitical supply disruption risk in the price of oil. So far, we're not seeing it. So far, there's virtually zero geopolitical risk premium built into the price of oil. But watch for the potential for Iran to become directly involved, especially if Israel starts to pivot and turns its sights from targets in the Gaza Strip to pushing Hezbollah in southern Lebanon away from that border region. That's the key flashpoint to watch, we think, for energy markets in the new year.
So the risk of further escalation, perhaps not, in your opinion, or in the opinion of some, not fully factored into the price of oil right now, which could be a bullish indicator. But how do we even determine the likelihood of further aggression? I mean, there are those who would say there's a lot at risk for Iran if it were to escalate beyond where we are today.
We would agree with that assessment. We estimate that the baseline consideration in Tehran is to not escalate into a full regional conflagration. They also have an interest in Iran in not becoming directly involved and the losses that would incur. And they also don't necessarily want to play the full Hezbollah card that they have in their pocket that serves as a powerful deterrent against Israel and Israel expanding its war in the direction of Lebanon. We think, therefore, that the major risk of a blow-up that would affect energy markets comes from the risk of miscalculation, of the sides miscommunicating their intentions, of pushing the envelope a little too far and not anticipating unintended consequences. A lot of times, that's how these things in history have tended to get out of control, and that's the risk here today in 2024 in the Middle East.
Now, just to come back to the price of oil itself, Clay, the narrative in the market today seems to be, and we've heard this a few times, WTI right now is modestly higher on the day, but that there are these broader oversupply concerns that are overshadowing the potential of more disruption to flow through the Middle East. What do you make of some of the headlines on the world being amply supplied with oil, and that's something that has been weighing on the price?
Well, at Rapidan Energy Group, we concur with those assessments, although we are still expecting a little bit of a global oil deficit in the first quarter of this year. This year looks to be pretty well supplied and balanced between demand and supply. So although demand will grow over the next couple of years by about 2.5%, 2.5 million barrels a day during that 2-year period, the front end of that outlook period looks a little bit loose. It looks a little bit sloppy. And likewise, new supply growth from the non-OPEC producers has been pretty robust. It surprised a lot of market observers to the upside in the second half of last year. And it looks like we'll bring on another more than 1 million barrels a day of non-OPEC supply growth as well. So the tough news for kind of the OPEC plus producers coalition is they're going to have to keep supply lower for longer. In other words, they thought that that period of time when they'd need to keep those supply cuts in force to balance the market would mostly be a 2023 story, second half of 23. But our analysis concurs with what you led with in the question. It's going to be a pretty loose oil market, certainly in the first half of this year. But actually, through the end of next year, OPEC Plus is probably going to need to keep some supply cuts, some supply curtailments in force in order to prevent very large surpluses from developing that would be really bearish for the price of oil.